Welcome to the Explainer. So if you file taxes as a freelancer or a small business owner, you're absolutely going to want to pay attention right now because your playbook, it's changing. Starting April 1st, 2026, the Income Tax Act 2025 is bringing in this massive, unified overhaul for presumptive taxation. We're going to break down exactly what this means for your bottom line using the direct source material so you are crystal clear on the new rules. Okay, let's dive into this. Here's our quick agenda. We'll look at the 2025 tax overhaul, explain what presumptive taxation actually is, and map out the eligibility and turnover limits. After that, we'll calculate your presumed income, reveal a pretty major loophole that just got slammed shut, and wrap up with some essential rules and warnings. First up, Section 1, the 2025 tax overhaul. Honestly, this is such a breath of fresh air. Under the old 1961 Act, you had to wade through over 800 sections of absolute bureaucratic nightmare. You were constantly bouncing between these fragmented rules under Sections 44AD, ADA, and AE, just trying to figure out your tax bill. But the new 2025 Act, the government has aggressively slashed the code down to 536 sections. All those fragmented, confusing rules are now unified under a single, highly rateable section, Section 58. Which brings us to Section 2. Presumptive taxation explained. So what is it? Well, presumptive income is exactly what it sounds like. It's a notional or presumed income. Instead of tracking your actual profit by agonizing over every single expense, it's just calculated as a fixed percentage of your total turnover or gross receipts. It's a massive time saver. Basically, the government just presumes a portion of your revenue is profit, and you get to focus on actually running your business instead of hoarding coffee receipts in a shoebox. Moving right along to Section 3, eligibility and turnover limits. So who can actually use this new playbook? Well, your business is eligible if you operate as a resident individual, a Hindu undivided family, or a firm. But, and you need to hear this, limited liability partnerships, or LLPs, are completely excluded, no exceptions. Plus, if you're in commission, brokerage, or run an agency business, you cannot opt in to Section 58 either. Let's just pause and let these numbers sink in for a second. For eligible businesses, we're looking at a two-tiered system. The standard turnover limit is 2 crore rupees. But the government is aggressively incentivizing everyone to go digital. So if you adopt digital payments, your eligible threshold literally jumps by a full crore, pushing your limit up to 3 crore rupees. And this brilliantly illustrates how professionals are treated under that exact same incentive structure. For professionals, the standard limit under Section 58 is 50 lakh. But again, if you transition your practice entirely to digital payments, that limit gets a massive 50% bump, taking you all the way up to 75 lakh. Now, you might be wondering, is there a catch? Yes, absolutely. Those higher digital limits come with a very strict condition, what I like to call the digital catch. To actually qualify for those higher caps, your cash receipts absolutely cannot exceed 5% of your total turnover. That's it. Go even a fraction over that 5% in cash, and you completely lose the benefit. All right, let's get into the math. Section 4, calculating your presumed income. For businesses, the government explicitly rewards digital behavior. Your presumed profit rate is just 6% on digital or banking receipts. But if you take cash, that presumed rate jumps to 8%. For professionals, though, it's a lot simpler. Regardless of your payment method, cash or digital, your presumed income is just a flat 50% of your gross receipts. Now, for Section 5, the loophole now closed. Let me tell you, this is a major plot twist for anyone who previously relied on presumptive taxation. Let's bust a huge myth right now. For years, there's been this long-standing point of confusion among taxpayers when reporting their profits. People were always asking, hey, if my actual profit margin is higher than the presumed rate, say my business actually profits 15% instead of 8%, do I just declare the 8% deemed percentage, or do I have to declare the actual 15%? Well, the 2025 Act provides a very critical clarification here. You must declare the higher of the prescribed rate or your actual profit. This totally stops businesses from underreporting by hiding their actual higher profits behind that lower deemed percentage. If you make a 15% profit margin, you declare 15%. The loophole is officially closed. And that leads us to our final part, Section 6, Essential Rules and Warnings. So the crucial point here comes down to a single number, 5. This represents the mandatory 5-year lock-in rule under the new Section 58.
Here's how it works. Once you opt into this presumptive taxation scheme, you have to commit to it for 5 consecutive years. Jumping in and out of the scheme whenever it suits you for a tax break, that's just no longer an option. If you opt out before that 5-year period ends and then try to opt back in later down the road, it triggers a mandatory audit requirement for the intervening years. The severity of this really cannot be overstated. You've got to carefully evaluate your 5-year business trajectory before you opt in.
Let's quickly summarize the high-stakes practical takeaways here. First, presumptive taxation definitely simplifies your compliance, but, it doesn't always guarantee tax savings. Second, declaring a low presumed profit might save you a little bit on tax today, but it is going to severely hurt your loan eligibility when you walk into a bank tomorrow. Third, your audit risk significantly increases if you try to declare profits below the presumptive rates. And lastly, as we just discussed, accurately classifying your cash versus digital receipts is absolutely critical to keeping those higher turnover limits. So, I'm going to leave you with this provocative question to ponder. Is the simplified compliance of Section 58 actually worth the 5-year lock-in and the potential audit risks for your specific business? Because let's face it, every business is unique. Now that you understand exactly how the Unified Section 58 works, I highly encourage you to sit down with your tax professional, take a hard look at your long-term goals, and figure out if this new playbook is the right move for you come April 2026. Thanks so much for learning with me today on The Explainer.